about what's taking place at the SED. I mean, we just heard from Gordon Chang earlier, who's an author of The Coming Collapse of China. He says not many high hopes here for any breakthroughs.
Well, I don't think there will be breakthroughs in the short time, but based on my observation that both the U.S. and China agree on something. That is, China will switch from peg to dollar to peg to a basket. So that will be out of the question. But of course, regarding the timing of the initial move and also regarding whether or not there will be one-off evaluation, there will be the question. And perhaps we will see the first initial move maybe in the winter.
In the winter? Some are looking at the G20 in Toronto next month.
Well, the Greek debt crisis does have some impact on the timing. So I don't think that China will move the RMB in June.
Oh, wow. Okay, so in the winter sometime, and we're looking at what? Very, very gradual appreciation? We're just going to see a depeg, basically? Is that it?
Well, there will be a depeg, and it will be the most important move will be pegged to the basket. But the U.S. and China perhaps are negotiating on two things. First, whether or not there will be one-off evaluation up front. Second, if there's no one-off evaluation, what's the scale of the appreciation of the RMB against the basket? That will be the key of the discussion.
This is Steve Engle up in Beijing. How fragile would you say the Chinese economic recovery is as well? Fragile might be an odd word coming, on the heels of the big GDP number we had in the first quarter. However, these administrative measures to cool the property market have had a significant dampening effect on property sales. And of course, again, when we're talking about the currency here, exports still remain weak. And with the euro's weakness, the yuan has actually appreciated about 14% against the euro over the past 4 months. So again, do you buy into the argument when Wen Jiabao last week says things are still fragile, we can't necessarily move right now?
Well, I don't think the situation in China is fragile, but of course it's not firm. So that's our view from the beginning of the year. The Chinese economy is not overheated, even after we learned the new development in Europe. Or even after we factor in the property tightening measures. So according to our views that some of the economists are just too optimistic or too bullish on economic GDP forecast, and we expect them to revise down their growth forecast from around 11% to all the way to 10% or even 9.5%.
9.5% growth, though, is not bad for an economy.
It's not bad. It's not bad, but we do expect a round of downward revision.
Okay. Now, let me ask you something, because in your note, you said Greece is not Lehman's. Let's be clear on that. So you're saying that this sovereign debt crisis is not as bad as everyone, doomsayers, are saying, right?
No. Yeah. The Greek crisis will have a marginal impact on China's economy and China's policy making.
Okay, marginal impact, meaning what? They'll delay the RMB appreciation, they'll delay interest rate hikes?
Especially on the RMB, because that's a move to be coordinated with international global situations. Regarding its impact on interest rates, I think it's very small. China's interest rate decision will be mainly dependent on China's own economy and inflation numbers. But actually, China's inflation now is not so high. It's 2.8% in April, and we expect no more than 3% in May.
Really? Because some people are expecting much higher inflation than that, considering we're seeing the property prices and even producer prices at 6%. I mean, that has to be passed on at some point, doesn't it?
Yeah, it will be passed, but the scale of the pass-through will be quite small. And what we need to focus in May is that vegetable price, which has been the main driver of China's inflation, declined more than 12% in the first 2 weeks, and we expect them to decline another 6% in the later part of the month. So which means that inflation risks might be much smaller than we expected.
Okay, so it sounds like China's economy, yes, will be dented by the European debt crisis mildly, but overall still firing on all cylinders, right? Not doing badly, how about that?
Not doing badly. We don't need to be too optimistic. We need to revise down inflation forecast and also GDP forecast. But we don't need to be very bearish. Of course, I just want to make it clear, we don't have any plan to revise our own forecast. We just expect market consensus to be revised down.
Okay, Ting Lu, thank you for dropping by. Ting Lu, China economist at Bank of America-Merrill Lynch here in Hong Kong.